Hi guys. For today's material, we are going to discuss about the account receivables budget, and I'm going to give this material in the form of interactive video. So please don't skip the video because maybe in the middle of the video, there are some question that you need to answer. Okay, we go to the definition of the receivables. The receivables are the right to collect an amount of assets from a creditor to a debtor who is willing to pay it off in the future. So as we know that the receivables happen because the company sells in the credit. So the company has the right to ask a creditor that someone who buys a product in the credit to pay his receivables. Okay. And then this is the types of receivables. We have securities receivables, repayment expenses, security deposits, tax receivables, note receivables, and account receivables. Okay, maybe we can say that the examples of the securities receivables and notes receivables is maybe quite the same. And then for securities receivable, for example, when the company receives the payment in the form of check, and as we know that the check usually written down in some specific time, so the company cannot liquidate the check until the time is come. So that's why it's called receivables, because they already have the payment, but they cannot make it cash. And then the payment expenses is just like when we are paying the rent before we use the property. So it is also, we can say that it is also under receivable because we haven't got the, we haven't used the property, but we already paid rent. And then the security deposits also are receivables because, for example, like you pay something, when you, for example, that when you sleep in the hotel and then the hotel asks you to pay some deposits, and then they will deposit is just for like a security for the hotel if there are some kind of like missing stuff, yeah, they can charge it into the deposits. But then the deposit can give it back to the person if the there's nothing happened in that hotel. That's for example, and then the security deposit here. For example, usually we can say that it's just like a bank guarantee in some project. So when a company make a bank guarantee, to as the requirement for the project, and after the project is finished and everyone is happy, and then the company will get the security deposits back. And then the tax receivables is the case that, for example, when the company is already paid the tax, but then in the end of the year, they've already known that well, actually they having a loss, yeah, instead of profit. When the company book they have in the loss condition, they don't need to pay the tax. So the company will get the money back. Yeah, so that's why it is also called receivables. But then in the case for in Indonesian case, usually to get the money back from the government is usually having a lot of paperwork to do. And then we have account receivables. Account receivables is when the company, use the sales by using the credit terms. So in this receivables budget, yeah, we will discuss the account receivables budget that arrives due to the company policy. And then next, okay, this is the benefits of the account receivables budget. The first one is the streamline and enlarged sales. Yeah, maybe you can imagine when we buy a property, just like house or cars or maybe a motorbike, we cannot buy it with credit, so it might impact to the decreasing of the sales. Yeah, how many people can buy a house or a car in cash? Yeah, so the benefits of account receivable is to enlarge sales, and of course here when they have like competitive the position of the receivables, they have an ability to compete with the competitors. And then also in the end, yeah, when they have an large sales, they can expand their customers. And then in the end, yeah, when the sales is going up, it is also increase the company profits. So this is are the benefits, but also as we know that it is also have disadvantages. Yeah, for example, there are a bigger risk because they are selling some products, but they haven't got the money back. Okay, this is, we also discussed the receivables policy. Yeah, for example, like the receivables limit that given, for example, yeah, you can buy the products in credits, yeah, if you buy in some amount of money, or determination of credit term. For example, when you buy a house, then you can like pay it back in 25 years, but you have to pay it for a month. That's for example. And then we can see here that the benefits of an account receivable budget is that the receivables are planned and directed and make it easier to calculate the return receivables. And then this is the factors that affecting the accounts of receivable budgets. This is the volume of goods sold on credit. Yeah, so we can see here that the volume of goods sold on credit is higher. It means that the account receivables also higher. So it is also creating a bigger risk. Yeah, because there's a lot of the transaction that been held in credits. And then the credit standards. The credit standards usually it is depends on the company's policy. For example, while they have some regulation about the credit sales and all that. Yeah, so if the standard is really tight, so it is affecting that the account receivable might be going down. And then the credit term. Credit terms, we can see that this is usually we have like a formula, for example, that for how long that the company can receive back their money, yeah, from the credit sales. Usually we have like a formula like a 5/10/net30 or something. So I will explain it later. And then we also cash discount here. Oh, this is the effect of the credit term is that is the term of the credit is longer. It means that the account receivables will also goes higher. And then the cash discount. The cash discount is also affecting to the account receivables. If the cash discount is bigger, people tend to buy the products in cash instead of in credit. So when many people buy in cash, it will affecting that the account receivables will be going down. And then the credit restrictions. This is about the requirement to make a credit sales. Yeah, for example, when you have like when you ask for the credit sales, you have to meet some requirements. For example, that you don't have any like a record, yeah, that have experience yeah, not paying the loan. Yeah, for example, it is also stated in BI checking, in Bank Indonesia checking, or like so the company will check about your credit record, yeah, whether you have an experience, yeah, uh to have a non-performing loan or not. Yeah, you've already paid all of your debt or not. Usually when the credit restriction is really tight, the account receivable is going down. Yeah, because people tend to prefer the cash sales than the credit sales. And then the receivables collection policy, yeah, it is regarding about how the company will do the collection of the receivables. If the policy is really tight, it means that if you are late to pay for a day, then the company will call you, and then the company will send a debt collector to your home. If the receivables collection policy is really tight, yeah, it can affecting that the account receivables is going down, because when the company terrorize you to pay the loan, yeah, usually you will have to commit to pay your debt. And then we are going next. This is the preparation of the receivables budget. Yeah, the receivables budget is based on the sales budget, and then we also have to what is called also to see, or also to I forgot, also to know about the credit policy. Yeah. And then we also need to consider the reserve for account receivable write-offs. Yeah. Or we can see here that how many the reserve that we can give for the bad debts. And then we need to calculate the net accounts of receivables. And then after that, we can make an account receivables budget. And then we go to the example here. Yeah, for example, that PT Every Little Thing has a sales plan in the first quarter of 2025 based on the end of month estimates as follows. For example, here, they have a sales plan in January as amount as 2,500,000, and then in February is 4,500, and in March is 2,250,000. So this is the term, the credit term, 5/10 plus net 30. It means that the credit term that the debitor need to pay as long as 30 days. But if they pay less than 10 days, they can get 5% discount. Okay. And we can see here that this is the habit of the customer. Yeah. Based on the customer experience, the payment methods are as follows. The 20% of sales are received every month within 10 days of the month of sales. So it means that only 20% of sales were paid during 10 days. And then 70% of sales are received each month within 10 days of the sales month. So it means that a customer who paid at least 30 days, 10 days to 30 days, it's only 70%. And there are 10% customers that pays late because they paid it on the next month. So you have to make a receivable budget for the first quarter of 2025. Okay, and this is the solution. So what we have to do here, okay, based on the sales budget above, there is some information. This is I've already talk about that, about the credit terms, 5%, 5/10/net 30. Yeah, you can see here that it is have a meaning that if the payment was received within 10 days, so they will receive cash discount of 5%. Yeah. But then the credit payment deadline is 30 days. So we can make a sales budget based on the type of sales, where based on the customer payment experience, 20% of payment will be in cash, and the remaining 80% discount is included in credit sales. So the first thing that we need to do, yeah, in this case is we differentiate which one is cash sales and which one is credit sales. Because all of the customers that pay in 10 days, they will have a cash discount. It means that all of the payment that happen within 10 days, we can differentiate it as a cash sales. Yeah. And the rest of the customers that paid after 10 days, we can differentiate it as a credit sales. Okay. Okay. So based on the information here, only 20% customer paid within 10 days. So we can say that the 20% of the customers is having a cash sales, and the other 80% that they make a payment after 10 days, yeah, the 80%, yeah, it is, we can differentiate it as credit sales. Okay, so 20% of 2.5 million is 500, and the rest is in credit sales. Yeah, the 80%. And then in February, yeah, we can have here the cash sales is 20%. The 20% from 4.5 million is 900. And the rest is in credit sales, 2.6 million. And then on March, we have sales around 3.25 million. And then the 20% of 3.25 million is 650,000. You can say that this is in cash sales, and then the rest is the credit sales. So after that, okay, this is because of my Adobe expired. So we can see here that this is the sales, yeah. This is the sales. We can edit, yeah, from January to March, yeah. And then we continue. This is actually just like what we do in the third meeting, how we differentiate sales based on type of sales. And now you have to focus on credit sales only, because the receivables happen, yeah, because of the credit sales. Okay, next. Okay, based on sales budget on the type of sales, we can create a receivable budget as follows. So you can see here in January, the credit sales is 2 million. So it means that in January, we have 2 million receivables. Okay. And then what happened in February? In February, we can see here that based on the habit of the customers, there are 10% of sales are received in the following month. So if the sales happen in January, the 10% of the customers will pay on February. The 10% of 2.5 million is 250,000. It is received by the company in February. Okay, is it clear? Okay, now we go to the February. We also depend on these tables. We can see here that on the February, we have credit sales around 3.6, and then we put here 3.6, and then remember that only 10% of the customers paid on the next month. So 10% from 4.5 million is 450. So the 10% or 450,000 that will be received by the company. And then on March, we can see here that the credit sales is 2.6. Yeah, we plug in the numbers. And then in April, I don't make a table on April. Yeah, on April, we will receive 325,000 rupiahs, but I didn't put it in here. Yeah, and then don't forget to add, yeah, the total of the receivables from January until March. Yeah. So that's it. Yeah, we've already made a receivable budget. It's quite simple, but remember, you have to differentiate between a receivable budget and the receivable collection budget. If the receivable budget, we calculate the unpaid receivables. So it means that on the January, there are 2,000 receivables that unpaid. Yeah. But then the collection of receivables budget is the amount of cash that received by collecting receivables. The collection of receivables budget, yeah, it is the amount of the cash that already being collected. Yeah, for example here that in January we have collect amount around 500. Yeah, minus the cash discount. Yeah, for example like that. Now we can continue to discuss later about the receivables, the receivable collection budget. It is on cash budget, and we will discuss it next week. Yeah, hopefully we can have a Zoom meeting or Google Meet to discuss about the cash budget. Okay, thank you very much for your attention, and don't forget, I also give you some tasks. You have to do it, yeah, for a week. Yeah, don't forget. Yeah, just check your admin. Okay, thank you very much. Bye-bye and see you again.